right, this is the Money Show, and in the first segment, let's welcome on board Gaurav Rastogi. He's the founder and CEO of Kuwera.in. Hi Gaurav, thank you so much for joining us on the show. So we have you here to talk about how one can review their portfolio. We're at the year end, almost just 2 more weeks to go. So if you want to analyze your portfolio, we want to talk to you about that. Can you tell us, before the end of the year, if you want to review, take a look back, what are the parameters to judge your portfolio on? Of course, returns is key, but what else are the other factors?
Right. So I think one of the first things that investors should look at is how has your portfolio changed over the past year. So precisely what we are talking about. One, if you started the year with about, say, 6 funds, and in December you think that your portfolio now has 12 funds, then there's something that you've done wrong. So one of the first things we like to review is, have you bought too many funds in your portfolio? People do over diversify. People do have this tendency to say, oh, this fund's doing well, let me buy a little bit of this, or that fund is doing well, let me buy a little bit of that. Year end is a very good time to review that process, to think back and see, why did I add 2 more large cap funds when I already had a really nice large cap fund in my portfolio, right? So that's number one. The second thing that investors should look at, very kind of focus on, is their asset allocation. Year end is a very good time to do that. I mean, I think it should be a January resolution that, hey, you know what, say you've decided that you want to be 80% in equities and 20% in debt. Over the year, the different asset classes will perform differently. And then you can take a call at the end of the year to say, okay, now I want to go back to my existing asset allocation. So if your asset allocation has moved from 80-20 to 70-30, this is a good time to go back to your original asset allocation. So on the macro perspective, this is not even going into returns, this is not even thinking about returns. Investors should think about, has bloat crept into their portfolio? Do they have too many funds? And also, are they still aligned to their original asset allocation? And if not, why? It's quite likely that something has changed in your life and maybe there is a new asset allocation that is required, but this is a good time to think about that.
How exactly can they go about doing it? Is there a method that they can use, or any kind of filters?
Couple of things. We look at a few what we call rule of thumb, principles on how to think about, especially how to think about portfolio bloat. A simple example, right? Like I just mentioned, if you have 3 large cap funds, really ask yourself that question: why do I have 3 large cap funds? It's just going to make your portfolio much harder to track. If you have exposure in a large cap fund and an exposure in a mid cap fund and an exposure in a small cap fund, but you still have 2 multi-cap funds. So what's the purpose of that multi-cap fund there? You already are well diversified across the capital structure. So that's another thing that people should think of. We see a lot of investors who will have a equity mutual fund, a debt mutual fund, but they'll also be invested in a hybrid mutual fund.
So would you recommend somebody to have a balanced sort of a portfolio instead of over-indulging in any one bracket?
Of course. I mean, it will not help you in the long run.
Because if multiple funds at the same time are doing well, for instance, a large cap fund, like you said, from two or three different fund houses,
right,
how should one choose which one is right?
Returns is not how we would say that you should go about choosing a fund.
Okay.
Our clear thing is that, okay, there are multiple fund houses, they have funds that are doing better. Think about which fund, and the fund managers will write about what their philosophy is, what their investment philosophy is. Think about which investment philosophy aligns the best with you. We do recommend actively to look at passive index funds, especially in the large cap space. So we do look at the Nifty 50 fund or the Nifty Next 50 mutual fund. It's a very good way to get exposure to large cap stocks in India without having to get into this nitty-gritty of which portfolio manager is better, whose performance will be better in the next 3 or 4 years, rather than just capture the returns that the market has to offer in that category.
Right, but what is, according to you, the ideal time to redeem your fund? Can there be an ideal time?
What we advise is you redeem when you need the money.
Okay.
Right. So timing is hard. stock timing is really, really hard. Mutual fund timing is also very hard. So there is no magic bullet that can tell you, this is a great time to buy this fund, and after about 18 months or 12 months or 11 months or whatever that time period is, then someone will come and give you another magic bullet. Hey, this is a good time to sell this fund. So the better idea is to have all your investments aligned to goals. You keep investing, you keep your portfolio clean, you keep your portfolio small so that you can analyze it easily, so that you can track it easily, and keep investing for your goals, and withdraw money when you really need it, or redeem those funds when you really need that money.
Is there any strategy that you recommend using while somebody is considering redeeming their funds?
Okay, so if you have, for example, a scenario could be that you have 5 or 6 different funds that you can redeem from. Definitely look at the tax impact.
Okay.
Definitely look at the tax impact and see whether any of those funds could have a short-term capital gains impact or a long-term capital gains impact when you redeem. How does that compare to the long-term capital gains tax that you have already kind of taken on your books in that given year? So tax considerations is a big thing. Second is, again, if there are fund categories where you have a lot more exposure, think about withdrawing from those categories. We advise against having a lot of sector exposure. Sector timing is incredibly hard. So if you happen to have a sector exposure and if it has done well and you need to redeem, look at your sector funds. That could be a good place to start. So again, some heuristics that one can use. There is no algorithm that can say, this is the best way to kind of redeem a fund, but these are some of the heuristics that you can use to figure out which are the right funds to withdraw from.
What if somebody's scheme is in the bottom half of the last quartile? Should they be worried, or while selling, or what should be the parameters or some key points to keep in mind?
If your funds are in the bottom quartile.
Yeah.
See, I mean, someone has to be in the bottom quartile. Like, having said that, it hurts if your funds are in the bottom quartile, and it's a very natural human reaction. It's a very behavioral thing to say, can I do something to fix it, right? And now, what a lot of academic studies and a lot of what data shows that if your fund is actually one of the worst performing funds in the last 3 to 5 years, that is absolutely the wrong time to give up on that fund. That reversion to mean in performance, whether it be in sector funds, whether it be in any kind of a fund style that different fund managers follow, usually happens in that 3 to 5 year time frame, right? So do think about that before you just redeem just because it's not performed well in a given year. Now, if it is not performed well and eventually you realize that, hey, this fund is not right for my risk profile, or if this fund has a very high expense ratio, or there might be other red flags around that fund, then yes, then it makes sense to redeem it and then invest it into an index fund or invest into other funds in your portfolio that have been doing well. But return chasing is not something that should be the primary goal or the primary idea when you are rebalancing your portfolio.
On that note, we'll take a break here, but do come back real soon. We have lots more lined up when we come back.